So when it comes to car loan interest, I really feel like it's not that hard to understand, but I do get a lot of questions on the channel asking about it. And honestly, I think a lot of people are being misled about how car loan interest works because there's a couple things that I have to debunk first here. The first thing that a lot of people tend to think is that your total loan includes the interest that you're going to be paying on the car. So for instance, if you finance a total of $22,000, a lot of people tend to think that the interest is included in that $22,000, and that is not true. Interest is going to be on top of your loan, and that is always the way that it works on simple loans for fixed interest rates. And a lot of people also think that the total interest that you'll pay on the car is just by taking the interest rate and multiplying it by the total amount that you borrow. So for instance, if you borrow $30,000 and you have an interest rate of 5%, then you multiply those together and you'll end up with $1,500. So a lot of people think that $1,500 is the total that you're going to pay in interest. And this is also not true because interest rates are generally applied yearly. That's why you see APY next to an interest rate. And because of that, if you have the loan for 3, 5, 6 years, that is going to change the math tremendously because as you pay down the loan, you pay less interest. And that's the main point of this video is I want to show you exactly how interest works so that you can do the math yourself and know for sure if the interest you're paying on the car is going to be worth it to you or not. Now, before I get into everything, I need you to understand that car loan interest is affected by 3 main areas, because the first area that you need to consider is how much you're actually going to be borrowing. Because obviously, if you have a $10,000 loan versus a $100,000 loan at even 1% interest, you're going to pay more in interest on the higher amount that you're borrowing. So you need to consider that first. And then the second area is obviously the interest rate itself. So if we're talking 0% interest, that's great. You're not going to pay any interest. But if we're talking 2% interest versus 10%, that can have a huge swing on how much interest you're going to pay over the life of the loan, especially if you borrowed a ton of money and you had a really long car loan. Because the third area that's affected surprisingly the most is the length of the loan. Because if you've got a 3-year car loan, you're actually going to have a higher monthly payment than a 5-year loan, but you're going to pay a lot less in interest because it's 2 years shorter. Because the way that the interest works is you start at the top and you slowly pay down the loan and you're only paying interest on what you owe. So if you can pay that off faster, then you're obviously going to pay a lot less in interest. So to keep this simple, let's pretend that you go out and you find a car that you really like, and after taxes, fees, down payment, everything, you end up financing $25,000. And let's say that your credit's pretty good and you end up with a 3% interest rate, and then you want to finance the car for 60 months, which is 5 years because that's how long you want the term to be. Now with that math, you're going to end up with a car payment of about $449, and then the total interest that you're going to pay for the life of the loan for the entire 5 years is going to be a little bit over $1,900. So you're really going to pay about $27,000-ish for the car, and that's how the math is going to work. But the question is, how did I get these numbers? Because I'm no rocket scientist here. I don't know how to do this math on my own, and I always just use a loan calculator, and that's exactly what I want you guys to do as well. You're going to look it up on an app store or just on Google, find any loan calculator, and you're going to plug in these basic numbers. I'll show you exactly how to do it and what the rest of the loan is going to entail for you. So right here inside the loan calculator, you can see that for the loan amount at the top, I put in $25,000, the interest rate 3% on a 5-year term. And then below here under payment, it tells you exactly what you're going to pay, which is $449 a month for 60 months. And then down here under the total repayment, you can see that you're borrowing $25,000. Your total interest is going to be $1,953, and then total repaid is $26,953 when everything is said and done. And that is exactly how a loan calculator works on the surface. All you have to do is plug in the different numbers that you're playing around with, and it will calculate everything for you. Now I want to show you the payment schedule inside the loan calculation so you guys can see that as you pay down your loan, you're also going to pay less interest. So right here on the very first payment, you're going to pay principal of $386.72 and interest of $62.50. Now let's go all the way down to month 15, and you can see here that it's changing significantly because now you're going to pay $400.47 in principal, and then you're going to pay $48.74 in interest. And this is because as you pay down your loan, you're going to pay less interest because you're only paying interest on what you owe. So what I would do if you really want to speed up the process is try and pay extra towards your principal every single month. That way the balance is going down even faster, and you're going to end up paying less in interest over the life of the loan, and you're going to end up paying off the loan early, which is just a win-win. Now that you know how to do the math yourself, you can obviously check this information whenever you're looking to buy a car, or you can check what's happening with your current loan. Because if you look into your loan and you realize that you have a really high interest rate and maybe it's pretty long, then it's probably a good idea to refinance, because you could be paying a ton of money in interest. Because if you take the exact same car loan of $25,000 over 5 years, but you change the interest rate to 12%, then you're going to end up with a way higher monthly payment, and you're going to end up paying over $8,000 in interest when the life of the loan is done. So you really want to pay attention to your interest rate, because now that same car is costing you about $6,000 more in interest just because you have a 12% loan versus a 3% loan. Now, if you do end up with a really high interest rate and you want to refinance it to a lower interest rate, most of the time you are going to have a pretty good credit score. So just keep that in mind if you're looking to get a lower rate. And in my opinion, if you're looking for a really good rate, then I would suggest going with your local credit unions, because a lot of the time they are going to have very competitive rates. Or you can go ahead and check out LightStream Auto Loans. I've got an affiliate link to them in the description below, which means I may be compensated if you click through it, but they have got very competitive rates for all different types of auto loans if you're interested in checking them out. Now, if you just happen to find this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So if you do have an interest in this type of content, feel free to subscribe. But thanks for watching this video. Have a great day.